Right now, there is a very good chance your bank is taking money from you every single month, and you agreed to it without reading the fine print. Not through fees, not through some scam. Through the interest they choose not to pay you. If you have savings sitting in a big, famous bank, you are probably earning about 1/100% on it. That is not a typo. 1/100%. Meanwhile, that same money, in a different account, with the exact same government protection, could be paying you 4% or more in 2026. On $10,000, that gap is around $430 a year. On a real emergency fund, it can be over $1,000 a year. Every year, for doing nothing different except where the money sits. In the next few minutes, I am going to show you the exact math, why banks get away with it, whether the alternative is actually safe, and the 20-minute move that stops the bleeding today. Stick around, because the last part is the one that changes how you look at your bank forever. Let me be clear about who this is for. This is not about risky investing. This is not about stocks, crypto, or getting rich quick. This is about the boring pile of cash that almost everyone has and almost everyone handles wrong. Your emergency fund. The money you are saving for a car, a trip, a wedding, a down payment. The cash you keep because you might need it soon and you cannot afford to gamble with it. That money should be safe. But safe does not mean it has to earn nothing. In 2026, with the Federal Reserve holding interest rates high to fight inflation, safe cash can finally pay you real money again. The problem is that the biggest banks, the ones with the branches on every corner and the ads during every game, are keeping almost all of that interest for themselves. And they are betting, correctly, that you will be too busy to move. So here is the map of what we are going to cover. First, what your bank actually pays you versus what is possible. Then the real dollar cost on your specific balance. Then why inflation makes it even worse. Then what a high-yield account really is, whether it is safe, and exactly how to switch. And at the end, the smarter options beyond a savings account, and the one reason this whole game exists. Let us start with the number your bank hopes you never look up. Open your banking app right now and find the interest rate on your savings account. If you bank with one of the giant national banks, you will very likely see something like 0.01%. Some show 0.02. A few generous ones hit 0.15. To translate that, at 0.01%, $10,000 earns you about $1 per year. $1. That is not enough to buy a coffee. Now compare that to the top high-yield savings accounts in 2026, which are paying somewhere around 4 to 4.5%. On the same $10,000, 4.3% is about $430 a year. Same deposit, same protection, $429 of difference, created entirely by the logo on the account. Here is the part that should make you angry. The banks can afford to pay you more. When the Federal Reserve raised rates, banks started earning much more on your deposits. They just did not pass it on to you, because they did not have to. The average customer does not check, does not compare, and does not move. So the big bank keeps the spread. That gap between what they earn on your money and what they pay you is one of the most profitable things in all of finance. And it is funded quietly, out of your account, every month. So ask yourself a simple question before we go on. If a stranger offered to hold your money and pay you $1 a year, while the bank across the street offered $400, would you even hesitate? You would not. And yet millions of people say yes to the $1 every day, just because they already have the app installed. Let us put a real number on what that convenience is costing you. Let us do your math, not a textbook example. Picture a healthy emergency fund. Financial guidance says 3 to 6 months of expenses. For a lot of people, that lands around $25,000. At a big bank paying 0.01%, that $25,000 earns you about $2.50 for the entire year. In a high-yield account at 4.3%, that same $25,000 earns about $1,075 a year. Read that again. Over $1,000, risk-free, for money you were keeping anyway. That is a car insurance payment. That is a month of groceries. That is a plane ticket. Gone. Every year, because the money is in the wrong account. And this compounds. If you leave that $1,000 a year in the account, next year you earn interest on it too. Over 5 years, the difference between the lazy account and the smart account on a $25,000 balance is not $5,000. It is closer to $6,000 once the interest starts earning its own interest. Now scale it to your life. If you keep $5,000, the gap is about $200 a year. If you are sitting on $50,000 for a house down payment, the gap is over $2,000 a year. The bigger your safe pile, the more the wrong account quietly costs you. And notice what we have not done. We have not taken on any extra risk. We have not locked the money up. We have not touched the stock market. This is the rarest thing in personal finance. More money, same safety, for a one-time 20-minute action. Now here is where it goes from bad to genuinely urgent, and it is the piece most people miss. Inflation. In 2026, prices rose about 3.8% over the year, the fastest pace since 2023. What that means in plain terms is that $1 today buys less than $1 did last year. So money that just sits there is not standing still. It is slowly shrinking. Do the math on the lazy account. Your money earns 0.01%, but everything you want to buy got about 3.8% more expensive. So in real terms, in what your money can actually buy, you did not earn nothing. You lost almost 4% of your buying power. On $10,000, that is roughly $380 of purchasing power quietly evaporating in a year, on top of the interest you never received. Now look at the high-yield account. Earning around 4% while inflation runs at 3.8% means you roughly keep pace. You are treading water instead of sinking. This is the whole point. When inflation is high, doing nothing is not neutral. Doing nothing is a decision to lose. A high-yield account will not make you rich, but it stops your safe money from silently bleeding value every single month. That is the difference between cash that protects you and cash that decays in a drawer. At this point, a very reasonable voice in your head is saying, "This sounds too good. There has to be a catch." If it is really the same safety and 400 times the interest, why does anyone keep their money at the big bank? Great question. The answer is not what you think, and it is the most important part of this whole video. Let us break down exactly what these accounts are. A high-yield savings account is not exotic. It is a normal savings account offered mostly by online banks and some credit unions. The reason they can pay you so much more is simple. They do not run thousands of expensive branches on every corner. They do not pay for the marble lobbies and the parking lots. They take those savings and hand a big chunk of them back to you as interest, because online, competing on rate is how they win customers. That is it. That is the whole secret. You are trading a physical branch you almost never visit for hundreds of dollars a year. And in 2026, when almost everything you do with your bank happens on your phone anyway, the branch is worth very little to most people. Now, the money itself works exactly like your current savings. You can move it in and out. You can link it to your checking account. You can pull it when an emergency hits. The one real difference is speed. A transfer between two different banks usually takes 1 to 3 business days, instead of being instant. So the practical rule is this. Keep about 1 month of spending in your regular checking for instant access and bills, and keep the rest of your safe cash in the high-yield account earning real interest. You lose nothing that matters, and you gain hundreds or thousands a year. So then, the catch. The catch is not risk. The catch is friction and inertia, and the quiet hope that you will never get around to it. Which brings us to the question everyone asks next. Is it actually safe? Short answer, yes, just as safe as your big bank, if you do one simple thing. In the United States, bank deposits are protected by the FDIC up to $250,000 per person per bank. That is the same government insurance that protects your money at the giant national bank. It is not a lesser version. It is the identical protection. So before you open an account, check for one line on their website. Member FDIC. If it is a credit union, the equivalent is NCUA. If you see that, your money, up to $250,000, is backed by the full faith of the federal government. exactly like it would be at the bank you already use. Let me kill the common myths directly. Myth 1. Online banks are sketchy startups. Reality. Many high-yield accounts are run by large, well-known institutions, and even the newer ones partner with FDIC-insured banks to hold your cash. Myth 2. If the app has a problem, I will lose my money. Reality. FDIC insurance protects the deposit itself, not the app. Even if a company failed, insured deposits are returned. Myth 3. It is complicated or risky like investing. Reality. It is a savings account. There is no market risk, no share price, no way to lose your principal within the insured limit. The only thing you are risking by switching is a couple of days of transfer time and 20 minutes of setup. The far bigger risk, the one nobody warns you about, is leaving the money where it is and letting inflation eat it. Safe does not mean earning nothing. In 2026, safe can finally pay. Okay, you have seen the cost, the inflation trap, and you know it is safe. Now let us actually do it. I am going to walk you through the exact steps so that by the time this video ends, you could have this done. It really is about 20 minutes. Here is the step-by-step. Step 1. Compare rates. Look up current high-yield savings accounts and sort by two things: the interest rate and whether it says member FDIC. Ignore flashy sign-up bonuses for a second and focus on a strong, consistent rate with no monthly fees and no minimum balance. Step 2. Open the account. It is the same process as any account. Your name, address, social security number for tax reporting, and you link it to your existing checking account. This part takes about 10 minutes. Step 3. Move your safe cash. Decide how much to keep in checking for bills and instant needs, usually about 1 month of expenses, and transfer the rest into the new high-yield account. The first transfer might take 1 to 3 business days to clear. That is normal. Step 4, and this is the step most people skip: automated. Set up a small automatic transfer, even $25 or $50 every payday, from checking into the high-yield account. This does two things. It quietly grows your safe cushion, and it means your savings are always working at the higher rate by default. Step 5. Leave it alone. This is not an account you check every day. It is a place your emergency fund and your short-term savings live and earn. That is the entire move. No advisor, no fees, no risk to your principal, no lockup. 20 minutes today, hundreds or thousands of dollars a year, for as long as that money sits there. There is almost nothing else in personal finance with a payoff that clean. Now, for the people who want to squeeze even more out of their safe money, let me give you 3 upgrades and exactly when each one wins. Option 1. Treasury bills. These are short-term loans to the United States government, as safe as it gets, and in 2026 they pay around the same as top savings accounts. The special advantage is tax. The interest on Treasury bills is exempt from state and local income tax. So if you live in a high-tax state, a Treasury bill can actually beat a savings account after taxes. The trade-off is that your money is committed for the term, usually 4 weeks up to a year, so use this for cash you know you will not touch for a set period. Option 2. Money market funds. These are offered by brokerages. They often pay a competitive rate, and you can usually access the money within a day or two. They are not FDIC insured, but government money market funds hold ultra-safe short-term government debt, so the risk is very low. These are great for cash parked at a brokerage that you want earning while you decide what to do with it. Option 3. I-bonds. These are government savings bonds designed to keep pace with inflation, which sounds perfect for exactly the problem we described. The catch is flexibility. You cannot touch an I-bond for 1 year at all, and if you cash out before 5 years, you give up the last 3 months of interest. So I-bonds are not for your emergency fund. They are for a slice of longer-term savings you want protected from inflation. Here is the simple way to think about all of this. Your emergency fund, the money you might need tomorrow, belongs in a high-yield savings account. Money you will not need for a set few months can go into Treasury bills for the tax advantage. And a longer-term inflation hedge can go into I-bonds. Match the tool to when you will need the money, And your safe cash goes from earning nothing to earning as much as safe money possibly can. So let us come back to the question from the beginning. If the alternative is this safe, this simple, and this much more profitable, why do banks get away with it? Here is the real answer, and it is not about interest rates at all. It is about inertia. Big banks are not selling you the best account. They are selling you the account you already have. They know that most people will read something like this, nod, agree completely, and then never actually move the money because life is busy and the current account is already set up. Their entire business model on your savings depends on you doing nothing. That $1 a year they pay you is not a mistake. It is a bet on your inaction, and most of the time, they win. Which means the move here is not really about a savings account. It is about deciding, once, that your default settings will work for you instead of against you. The people who quietly build wealth are almost never the ones making dramatic, risky bets. They are the ones who fix the boring defaults. The account, the automatic transfer, the small leak that drains $1,000 a year while nobody is watching. This is the most boring, most guaranteed raise you will ever give yourself, and it is sitting there waiting, one transfer away. So here is your one action from this video. Open your banking app, look up the interest rate on your savings, and if it starts with a 0.0, you now know exactly what to do. Compare high-yield accounts, check for member FDIC, open one, and move your safe cash over. 20 minutes, and you stop paying the silent tax you never agreed to. If this changed how you see your bank, subscribe, because the whole point of this channel is finding these quiet leaks and sealing them, one boring, powerful move at a time. And if you want the next piece of the puzzle, go watch the video on building your first emergency fund, because once you know where to keep your safe money, the next question is how to grow it in the first place. Take care of the boring stuff. It pays better than almost anything else.